The start of this year has been interesting to say the least. The S&P 500 has been climbing, up 8% since the start of the year. The FTSE is also up 5%, which admittedly isn't the best representation of the UK economy since around 80% of its income comes from overseas. But even the FTSE 250, which is a more accurate representation of the UK economy, is up nearly 5% too. I don't know about you, but as much as I love seeing those green numbers, I can't help but think, with a cost of living crisis, inflation being so high, plus us being on the brink of World War III, what is actually going on? So I did some digging and here is what I found out. In the US, last year we saw the S&P 500 drop 20% in value. While many expected it to continue falling into 2023, but it's actually done the opposite. Now there's three things people are putting this down to. The first is a reopening of China's economy. China has reopened from its COVID-19 restrictions, which will accelerate companies' economic recovery and will also boost other global markets. This opened faster than expected, and it's forecasted that China's GDP will grow by 6.5% in 2023. This will also boost global growth through three direct channels. First is increased domestic demand. The reopening is expected to increase exports from Chinese trade partners, and reopening should increase their exports by 5%, which will be welcome news across the Asia-Pacific economies, which should boost their GDP by 0.4% too. And while this might benefit companies like Australia more than the US or the UK, there's no denying that we have had countless issues from import on a ton of goods from China. This lifting of sanctions will go a long way to helping that. Secondly, it'll open up international travel, which will make business deals easier to conduct. And thirdly, perhaps something you wouldn't immediately think of, is it will boost demand for their commodities like oil. Chinese oil demand could recover by at least 1 million barrels per day, which could help globally with supply issues and the restrictions coming from Russia globally. Now, the second factor helping the market right now relates to everyone's favourite word: inflation. Essentially, over the past year, there's been this tug of war going on across both the US and the UK markets. On the one hand, you've got excessive borrowing, mostly due to COVID and oil prices. Then on the other hand, we've got the Bank of England, who's trying to keep inflation from going out of control. And I think this is quite pressing at the moment because on the one hand, we've got across a range of sectors people striking and demanding more pay. On the flip side of this, if the government goes ahead, which let's face it, it's pretty much just printing more money and generating debt to do so, that leads to inflation rising even more. And then the bank rate is continuing to rise. Now obviously a lot of people should be getting a pay rise, but the problem is you have to do this across the board. It's no good, for example, giving one person a pay rise, then someone else in a different industry who might not be getting as much pay, who's already struggling, getting increased mortgage costs which come off the back of it. So both the Federal Reserve in the US and the Bank of England are increasing their rates to try and bring inflation back down under control, which seems to be working. We can see that from its peak of 9.1% in June 2022, it's now down to 6.4% in Jan 2023. The UK story isn't quite as impressive, but it's still dipped. 11.1% in October, now down to 10.1% in January. Not a huge dip, but a dip all the same. The bank rate in the UK is currently at 4%, and their goal to keep inflation under control is actually 2%. And when we look back over a 25-year timeline, we can see just how drastic the rate is compared to where it needs to be. Before we move on, I have to say a huge thank you to &Me for sponsoring today's video. &Me is an easy to use investing app powered by M&G Wealth, a leading wealth management company. The app recommends investments that are personalised to your investing style, taking the guesswork out of investing and using their expertise to help you make the right investment decisions. They have ISAs, pensions and general investment accounts. You can choose between different investment styles, including socially responsible portfolios, so you can feel confident about where your money is invested. I've invested £500 into one of their general investment accounts and I'll let you know how I get on. They provide investment expertise to help you with your decisions, giving you the confidence to get started managing your money. Head to the link in the description now to download the app and start seamlessly investing with &Me. The other factor affecting the US market is the softening of the US dollar. The price of the dollar has weakened over the past months, which is good and bad news. It can help by boosting exports. A weaker dollar makes US exports cheaper for foreign buyers, which can boost demand for American goods and services. This can lead to increased sales and revenues for US businesses, which can support economic growth and potentially increase employment. But it can also increase import costs. A weaker US dollar can make imported goods more expensive for American consumers, as it takes more dollars to purchase the same amount of foreign currency. This can lead to inflationary pressures, as higher import costs can result in higher prices for goods and services across the economy. Overall, the impact of a softening of the US dollar on the global economy can be complex and depend on a range of factors, including domestic and international economic conditions, trade policies, and geopolitical developments. Yeah, that's a mouthful. But considering the dollar rose to what some people would call expensive and seeing it return to slightly more normal levels, in my view, is a good thing. But this temporary pullback in inflation, the dollar softening, and the reopening of China has helped lift all of these economies. There is a slight sideline to this, and some people believe it's more a reflection of the seasonal January effect, where stocks are typically higher, and they class it as a short covering after a tough end to December and a brutal year. There's a belief that the stock performance in the first month of the year predicts the performance for the rest of the year. But even if this is true, this has left people with some concerns, as we have a lot of Q4 reports to come, which may not be very positive. The growing sense on Wall Street is the US economy may avoid a recession and instead wind up slowing to a soft landing. More of a gradual slide in the economy that doesn't lead to a massive spike in unemployment or a huge pullback in consumer spending. They believe the final leg of the bear market should come when the Federal Reserve signals a dovish stance on their policy, which essentially means they achieve low interest rates, which will help the economy to grow. If we look at the UK more specifically, it's interesting. We've had some nice recovery to start the year, but when we look at the FTSE's performance since Brexit, we've pretty much gone nowhere. While the S&P 500 has doubled and the Euro Stoxx 50 has gained about 30%, which is an index of European stocks. Analysts are saying that the trend that helped the FTSE's performance last year, such as a rally in oil, weak currency and rising interest rates, are starting to fade or are now priced in. The UK is also losing its advantage as the financial hub, with Paris catching up at the end of the year and is now firmly in the lead. The UK is in a tough position where it needs to stimulate growth, but it also needs to tackle the huge cost of living crisis, which can really counteract each other. Despite growth continuing to be an issue for the UK, which, let's face it, it always has, the UK is full of boring dividend giants, which is a big plus. Especially for this year where growth isn't particularly guaranteed for any market, dividends could deliver a very good return. So while the markets aren't crashing just yet, in fact weirdly they're going up, it doesn't particularly mean we're out of the woodwork just yet. A lot of top investors are saying we're due the worst recession since 2008, and while that could be true, remember a lot of news with the stock market is already priced in. And it does make great news to call the next recession. In fact, if you say the stock market is going to crash every week, when it eventually does, you'll be the savants who predicted the crash. As a normal investor, our best bet is to continue to average in through the ups and the downs of the stock market and average into our positions. I'll be continuing to buy right through this year through the ups and the downs. To see how I get on, make sure you're subscribed to follow along, and if you want to see my plan in more detail, you can check it out right here, and I will see you guys over there. Thanks.